Central banks stand at the heart of modern economies, wielding significant influence over monetary conditions and, by extension, the general price level. Their pivotal role in controlling inflation is one of the most scrutinized and debated aspects of economic policy. The effectiveness of central banks in maintaining price stability is not only a testament to their institutional design and independence, but also to the sophistication of the tools they employ and the credibility they command among market participants and the wider public. Understanding how central banks navigate the complex terrain of inflation control requires an appreciation of both the theoretical underpinnings and the practical realities that shape monetary policy. Inflation, defined as the sustained increase in the general price level of goods and services in an economy, erodes purchasing power and can have deleterious effects if left unchecked. High and volatile inflation distorts price signals, undermines savings and investment, and disproportionately affects those on fixed incomes. Conversely, deflation or falling prices can be equally damaging, leading to reduced consumer spending, lower economic growth, and increased real debt burdens. Central banks, therefore, aim to foster an environment of low and stable inflation, which is widely regarded as conducive to sustainable economic growth. The origins of central banking trace back to institutions like the Bank of England, established in the late 17th century, initially to manage government debt and issue currency. Over time, the mandate of central banks evolved to encompass broader macroeconomic objectives, with inflation control emerging as a central focus in the 20th century. The experience of hyperinflation in countries such as Germany in the 1920s and, more recently, Zimbabwe and Venezuela underscored the catastrophic consequences of uncontrolled money creation and the need for a disciplined approach to monetary management. At the core of central bank operations is the control of the money supply and the setting of short-term interest rates. The relationship between money supply and inflation has been a subject of intense debate among economists. The classical quantity theory of money encapsulated in the equation mv equals py, where m is the money supply, v is velocity, p is the price level, and y is output, posits a direct link between money growth and inflation, assuming velocity and output are stable. While this relationship is more nuanced in practice, especially in the short run, excessive expansion of the money supply relative to output remains a primary driver of inflation. To manage inflation, central banks deploy a range of policy tools. The most prominent is the manipulation of policy interest rates, such as the federal funds rate in the United States or the repo rate in India. By raising interest rates, central banks make borrowing more expensive, dampening consumption and investment, and thus reducing upward pressure on prices. Conversely, lowering rates stimulates economic activity, but, if overdone, can fuel inflation. Open market operations, wherein central banks buy or sell government securities, are used to inject or withdraw liquidity from the banking system, thereby influencing the money supply and short-term rates. Reserve requirements, which dictate the proportion of deposits that banks must hold in reserve rather than lend out, provide another lever for central banks. Higher reserve requirements restrict the ability of commercial banks to create credit, thus curbing money supply growth and inflationary pressures. Conversely, lowering reserve requirements can stimulate lending and economic activity. In addition to these traditional tools, many central banks have adopted unconventional measures, particularly in the aftermath of the global financial crisis of 2007-2008. Quantitative easing, QE, for instance, involves large-scale purchases of longer-term securities to lower long-term interest rates and boost asset prices. While QE was initially designed to combat deflationary risks and support economic recovery, it also has implications for future inflation, necessitating careful calibration and eventual unwinding. A critical factor underpinning the effectiveness of central banks in controlling inflation is their independence from political interference. Empirical research suggests that countries with more independent central banks tend to experience lower and more stable inflation rates. This is because independent central banks are better able to resist pressures to finance government deficits through money creation, which historically has been a major source of runaway inflation. Institutional arrangements, such as fixed terms for central bank governors, legal prohibitions against monetary financing of fiscal deficits, and clear mandates focused on price stability help safeguard central bank independence. Transparency and communication have also become vital components of modern monetary policy. Central banks increasingly recognize that managing expectations is as important as manipulating actual policy levers. Forward guidance, whereby central banks communicate their future policy intentions, helps anchor inflation expectations and reduce uncertainty. If households and firms believe that the central bank is committed to keeping inflation low, they are less likely to demand higher wages or raise prices in anticipation of future inflation, making it easier for the central bank to achieve its objectives. The adoption of explicit inflation targeting frameworks by many central banks represents a significant evolution in monetary policy. Under inflation targeting, the central bank publicly commits to a specific inflation rate, typically around 2%, and uses its policy tools to steer the economy toward that target. This approach enhances accountability and transparency, as deviations from the target must be explained and justified. The experience of countries such as New Zealand, Canada, and the United Kingdom demonstrates that inflation targeting, when credibly implemented, can help anchor expectations and deliver stable prices. However, the task of controlling inflation is fraught with challenges. The transmission mechanism of monetary policy, the process by which changes in policy rates affect inflation, is complex and subject to lags. Changes in interest rates may take several quarters to fully impact spending, investment, and ultimately prices. Moreover, the effectiveness of monetary policy can be impeded by factors such as financial market disruptions, global capital flows, and structural changes in the economy. Globalization has added a further layer of complexity. The integration of goods, services, and financial markets means that domestic inflation is increasingly influenced by external factors such as commodity prices, exchange rates, and international demand conditions. For instance, a surge in global oil prices can feed directly into domestic inflation, even if domestic demand remains subdued. Central banks must therefore carefully weigh the sources of inflationary pressures and calibrate their response accordingly. Exchange rate dynamics present another challenge. In emerging market economies, for example, depreciation of the local currency can lead to imported inflation as the cost of foreign goods rises. Central banks may intervene in foreign exchange markets or adjust interest rates to stabilize the currency, but such actions can have trade-offs with other policy objectives, such as supporting growth or maintaining financial stability. The interplay between monetary and fiscal policy is also crucial. While central banks control the money supply and interest rates, fiscal authorities determine government spending and taxation. Expansionary fiscal policy, if not matched by corresponding monetary restraint, can stoke inflationary pressures. Conversely, tight fiscal policy can complement central bank efforts to rein in inflation. Coordination between monetary and fiscal authorities is therefore essential, though it must be balanced with the need to preserve central bank independence. The experience of advanced economies in the late 20th and early 21st centuries illustrates both the successes and limitations of central banks in controlling inflation. The so-called Great Moderation, A period of low and stable inflation from the mid-1980s to the mid-2000s was attributed in part to improved monetary policy frameworks and greater central bank credibility. However, the global financial crisis exposed the limits of conventional tools, as central banks struggled to prevent deflation and stimulate demand despite near-zero interest rates. The subsequent era of ultra-loose monetary policy raised concerns about potential future inflation, asset bubbles, and the distortion of financial markets. Emerging and developing economies face additional hurdles in controlling inflation. Structural factors, such as less developed financial systems, greater exposure to commodity price shocks, and weaker institutional frameworks, can complicate the conduct of monetary policy. In some cases, central banks lack the credibility or operational independence needed to anchor expectations, making inflation control more difficult. Dollarization or currency substitution, where residents use foreign currency for transactions and savings, further undermines the effectiveness of domestic monetary policy. Despite these challenges, the central bank's overarching objective remains the preservation of price stability. This is not merely an end in itself, but a prerequisite for sustainable economic growth and social welfare. Stable prices facilitate long-term planning, encourage investment, and protect the most vulnerable members of society from the ravages of inflation. At the same time, central banks must be vigilant against the risks of deflation, which can be equally pernicious. In recent years, central banks have had to contend with new sources of inflationary pressure, including supply chain disruptions, labor market mismatches, and geopolitical tensions. The COVID-19 pandemic, for example, led to unprecedented fiscal and monetary stimulus, followed by rapid increases in prices as economies reopened and supply struggled to keep pace with surging demand. Central banks responded by tightening policy, raising interest rates, and signaling their determination to bring inflation back to target. These episodes highlight the importance of agility, clear communication, and a willingness to act decisively in the face of evolving risks. Looking ahead, the role of central banks in controlling inflation is likely to become even more challenging. Demographic shifts, technological change, climate-related shocks, and the ongoing evolution of the global economic order will all have implications for inflation, dynamics, and the conduct of monetary policy. Central banks will need to continue refining their analytical tools, strengthening their institutional frameworks, and building public trust to fulfill their mandate effectively. One area of growing importance is the interaction between monetary policy and financial stability. The global financial crisis underscored the dangers of neglecting systemic risks in the pursuit of price stability. Central banks are now increasingly tasked with monitoring and addressing vulnerabilities in the financial system, such as excessive leverage, asset bubbles, and liquidity mismatches. Macroprudential policies, which aim to mitigate systemic risk, are being integrated with traditional monetary policy tools to ensure that efforts to control inflation do not inadvertently sow the seeds of future crises. Another emerging issue is the potential impact of digital currencies and financial innovation on the transmission of monetary policy. The rise of cryptocurrencies, central bank digital currencies, CBDCs, and new payment technologies could alter the way money circulates in the economy and challenge the traditional mechanisms through which central banks influence inflation. While these developments offer opportunities for greater efficiency and inclusion, they also pose risks to monetary sovereignty and require careful regulatory oversight. The environmental dimension of central banking is also gaining prominence. Climate change and the transition to a low-carbon economy have the potential to affect inflation through multiple channels, including energy prices, supply chain disruptions, and changes in consumer preferences. Central banks are increasingly incorporating climate-related risks into their analysis and exploring how monetary policy can support the broader transition to sustainability without compromising price stability. In sum, the role of central banks in controlling inflation is multifaceted and dynamic. It encompasses the design and implementation of monetary policy, the safeguarding of institutional independence, the management of expectations, and the adaptation to new economic realities. While the tools and frameworks may evolve, the fundamental objective remains unchanged: to preserve the value of money and promote conditions conducive to prosperity and stability. The history of inflation control is replete with lessons for policymakers. Episodes of runaway inflation, whether in Weimar Germany, Latin America in the 1980s, or more recent cases in Zimbabwe and Venezuela, demonstrate the dangers of unchecked money creation and the erosion of central bank credibility. Conversely, periods of successful inflation control, such as the post-inflation targeting era in many advanced economies, highlight the benefits of clear mandates, sound institutional arrangements, and transparent communication. Yet no central bank operates in a vacuum. The interconnectedness of the global economy means that domestic monetary policy is influenced by external shocks, capital flows, and policy decisions in other jurisdictions. Coordination among central banks, particularly during periods of crisis, can help mitigate spillovers and enhance the effectiveness of inflation control efforts. Public trust is perhaps the most valuable asset a central bank possesses. Confidence in the central bank's commitment to price stability underpins the anchoring of inflation expectations and the smooth functioning of monetary policy. Earning and maintaining this trust requires not only technical competence, but also transparency, accountability, and a willingness to engage with the public and explain policy decisions. The future of inflation control will undoubtedly bring new challenges and uncertainties. Technological innovation, demographic change, shifting patterns of globalization, and the imperative of environmental sustainability will all shape the economic landscape in which central banks operate. Adapting to these changes while remaining steadfast in the pursuit of price stability will require resilience, adaptability, and a commitment to continuous learning. In conclusion, central banks play a central and indispensable role in controlling inflation. Through the judicious use of policy tools, the maintenance of independence and credibility, and the effective management of expectations, they help safeguard the value of money and create the conditions for sustained economic growth. While the challenges are many and the environment is constantly evolving, the fundamental principles of sound monetary policy remain as relevant today as ever. The ability of central banks to adapt, innovate, and maintain public trust will determine their continued success in fulfilling their vital mandate in the years to come.